Welcome to The Explainer. Today, we're putting on our market historian hats to dig up a forgotten financial bubble that feels actually scratch that, it feels uncomfortably familiar. Now, we aren't talking about the dot-com bust of the early 2000s, and we aren't talking about the 2008 financial crisis. No, we are digging way back into the early 1970s to uncover a crash that completely decimated portfolios, yet nobody really seems to talk about it anymore.
Okay, let's dive right into this by looking at a legendary warning from Sir John Templeton. This is a guy who averaged a phenomenal 15% annual growth for almost 4 decades, right? And he famously warned that "this time it's different" are literally the 4 most expensive words in the English language. He knew perfectly well that investors will do whatever mental gymnastics they need to convince themselves that basic financial rules just no longer apply to them. And you know what? He was right, because absolutely nothing empties a brokerage account faster than blind optimism dressed up as financial genius.
To truly understand what's happening in today's market, we really need to listen to pioneer Jesse Livermore. He understood that speculation and blind optimism are, well, they're as old as the hills. He built his entire fortune shorting markets during crashes because he recognized that human psychology just doesn't change. Whatever happens in the stock market today has happened before, period. And the forgotten bubble we're about to explore together, it's a striking, incredibly powerful example of exactly that.
So let's look at the illusion of blind optimism.
Picture this. Following World War II, the United States was riding a massive 20-year economic sugar high. Factories were absolutely booming, suburbs were just popping up out of nowhere, and Americans felt totally undeniably invincible. People had money, they had confidence, and most dangerously, they had blind optimism. I mean, between the end of the war in 1945 and 1970, we beat Germany, we put a man on the moon, and hey, we even invented the Etch-a-Sketch. All this undeniable confidence resulted in an unprecedented, roaring 350% stock market gain. And this supreme, unwavering confidence? It birthed a brand new investing strategy that got wildly popular on Wall Street. They called them one-decision stocks. These were blue-chip powerhouses that generated incredibly stable cash flows. We're talking about massive household names like Coca-Cola and American Express. Investors perceived them as so incredibly dominant and so bulletproof that there was literally only one decision you ever had to make: buy them and never ever sell. Selling was considered completely crazy.
Which brings us perfectly to the infamous Nifty 50 bubble.
Seasoned market historians officially called this specific era the Nifty 50 bubble. This was a concentrated group of 50 untouchable companies that investors genuinely believed had just started defying financial gravity altogether. And we're not talking about emerging tech companies or risky penny stocks here. These were the absolute bedrock of the American economy. But look at how heavily concentrated the market became. Just those top 50 companies were swallowing up roughly 45% of the entire U.S. stock market. Just take a second to think about that scale. Nearly half of every single dollar invested in broad stock market indexes was a massive bet that these specific Nifty 50 companies would somehow justify the ridiculous price tags being slapped on them.
This whole never sell mentality pushed valuations straight into fairy tale territory. Just to put this in perspective, a normal, respectable price-to-earnings ratio for the overall market at the time was around 15. That's a number that makes sense, right? But the Nifty 50, they averaged a jaw-dropping 42 times earnings. Coca-Cola hit 46, McDonald's reached 86, and Polaroid, an astounding 90 times earnings. They were priced as if literally nothing could ever go wrong.
But of course, things did go wrong. Let's look at the macro triggers and the ensuing crash.
As any seasoned market historian will tell you, whenever a no-brainer investment seems to have absolutely zero downside, it is almost always a financial grenade with the pen already pulled. Between 1973 and 1974, specific macroeconomic dominoes started to fall, and boy did they slap reality back into the market. Look at these warning signs. First, oil prices didn't just tick up, they quadrupled. Inflation aggressively surged from 3% to over 11%. Unemployment doubled from 4.5% up to 9%. And on top of all that, President Nixon effectively ended the gold standard for good. These massive, compounding macroeconomic triggers completely shattered the illusion of a bulletproof economy, and they set off a brutal 50% plunge. That marked the worst bear market since the Great Depression.
And when those dominoes fell, these wildly overpriced one-decision stocks didn't just experience acute, mild correction. No, they were completely obliterated. It turned into one big financial obituary. Coca-Cola shares plummeted over 60%. McDonald's dropped 70%.
And former market darling Polaroid? It collapsed by more than 90%. It turns out when the broader economy falls apart, incredibly high valuations provide absolutely zero safety net.
That leads us to what we call the 8-year purgatory.
The real gut punch of this entire era wasn't just the initial drop, though. It was the agonizing recovery. See, today we've gotten so used to these rapid V-shaped bounce backs, kind of like the one we saw immediately after the 2020 pandemic. But when a highly concentrated market bubble bursts, the long-term impacts on portfolios is a brutal, drawn-out punishment. It took 8 long years of grueling financial purgatory, all the way until 1981, for the market to finally crawl back to the exact same levels it had been at right before the bubble popped. Investors who honestly thought they were buying eternal growth stocks were just trapped, waiting nearly a decade just to break even.
So, if this whole historical story is giving you a slight sense of déjà vu as you look at today's market, trust me, you certainly aren't alone. We have to remember Mark Twain's incredibly wise observation here. While history does not repeat itself perfectly, it undeniably rhymes. And today's stock market is starting to rhyme heavily with the exact setup we saw in 1972.
Let's explore those echoes in the Magnificent Seven.
This brings us directly to the modern echo of the Nifty 50. Today, we call them the Magnificent Seven, the shiny, incredibly innovative technology giants of our time. And investors right now are treating them with the exact same reverence we saw half a century ago. Remember how the 50 companies of the Nifty 50 carried nearly 45% of the US market? Well, today, just 7 companies, Apple, Microsoft, Google, Amazon, Meta, Tesla, and Nvidia, carry the massive staggering weight of around 36% of the entire S&P 500. It's the exact same plot, just playing out with modern special effects.
So how do we avoid falling into the same trap? Let's talk about spotting unsustainable growth signs.
Now, don't get me wrong, today's tech giants are undeniably innovative. And yes, they completely dominate their industries. But we have to remember, so did Xerox, so did Avon, and so did Polaroid back in 1972. We have to put aside our own blind optimism and seriously ask if current valuations are sustainable or if these specific stocks are once again being priced like gravity simply no longer exists. Just look at these numbers. While Meta and Google sit around a somewhat elevated 28 times earnings, Amazon is at 35, Apple is at 37, and Microsoft is at 38. Then we reach Nvidia at a staggering 50 times earnings and Tesla at an eye-watering 247. Are these solid companies? Absolutely. But are they wildly overpriced, heavily overweighted, and worshipped as if they are completely bulletproof? For sure, yes.
Based on our historical analysis of that 1970s crash, we can actually extract 3 clear tips for spotting the warning signs of unsustainable growth bubbles today. Number 1, watch closely for when the broader market starts actively ignoring reasonable baseline valuations. Number 2, be super wary of the dangerous assumption of eternal corporate growth. Nothing goes up forever. And number 3, look out for investors blindly embracing and accepting incredibly heavy, dangerous portfolio concentration.
Warren Buffett really sums up the ultimate historical tragedy perfectly with this quote. He says, "What we learn from history is that people simply don't learn from history." Once again, we find ourselves staring at a highly top-heavy market, pretending that underlying valuations simply don't matter, and telling ourselves that exact same comforting bedtime story. So, we want to leave you with this final thought to conclude today's explainer. As we watch new macroeconomic dominoes potentially stack up in our own time, are today's investors simply whispering those 4 expensive words again? Are we completely ignoring financial gravity, or is this time truly different? Thank you so much for joining us for this explainer, and keep asking those hard questions.